Operating leverage measures the amount of risk that the firm has. It measures the firm's appetite for risk. And we calculate the operating leverage by dividing the contribution margin by the net income. And that result is called a ratio. It's going to be an absolute number. The higher that ratio is, the more risk the firm has, the more volatile it is to changes in its dollars of sales. So it's a teeter-totter situation. If you have a high leverage ratio, changes in the sales will move and make greater changes in your operating bottom line. If you have a low level of leverage, it'll be a smaller change in your bottom line. We have two companies here, Alpha and Beta. They have exactly the same dollars of sales, they have exactly the same operating income, but they have different amounts of fixed and variable cost. Alpha Company has more variable cost than Beta. Beta has more fixed costs than Alpha. So Beta is carrying a higher level of risk. So changes in Beta's dollars of sales in units will have a greater impact on the increase or decrease in its profits. So if you divide 500,000 by 50,000, you get 10. If you divide 800,000 by 50,000, you get 16. You could not take the published statements of two different firms in the same industry and make this calculation, because the published financial statements do not give you the breakdown between their fixed and variable cost. That is highly proprietary information, and they don't disclose it to the reading public. Now, quite often, companies will belong to trade associations, and they will send their financial information to the trade association that will turn it and combine it into generic information that they then feed back out. So based on your size or geographic location, things of that nature, you may be able to compare yourself and calculate the operating ratio based on your particular peer group. Now, here's what happens. As Beta increases their sales in units, they're going to spread their fixed costs over more and more units, which is going to reduce the fixed cost per unit. Now, as Alpha increases their sales in units at the same pace, they're still dragging along a lot of variable costs. So their total cost per unit will not drop as rapidly as Beta's. And so let's see what happens. Let's say the sales in units in both companies increase by 10%. So if Alpha has a leverage ratio of 10 and they increase their sales in units by 10%, you multiply 10 times 10 and get 100%. Now Beta would increase their sales by multiplying 16 by 10, or 160%. So the operating income of Alpha would increase by 100%. 100% times 50,000 would be a new Alpha income of 100,000. Betas would multiply by 160%, so their new operating income would be 130,000. Because 60% of 50,000 is $80,000. If you don't believe that, put it in your calculator. Now, if sales drop, just the opposite is going to occur. Alpha sales, if they went down by, let's say, 10%, then their operating income would be zero. If Betas went down by 10%, they would be in a $30,000 loss. So think back to the teeter-totter example I showed you earlier. So why is this important to management? Well, it gives them a lesson in how to handle and manage their costs. Again, think about that break-even chart when I talk about economies of scale. As businesses mature, they accumulate more fixed costs. And particularly as they get older, they have more fixed costs than a young company. And this can be advantageous or disadvantageous. As we just saw, it's advantageous if they have a lot of fixed costs that can spread over many more units. They'll be more profitable. Let's look at the automobile industry in the years 2008 and 2009. General Motors, Chrysler, and Ford had been losing market share for a number of years. Yet they had become very large companies with a lot of fixed costs, a lot of bricks and mortar, huge pension plan obligations, and so forth. So as their sales started dropping drastically in those 2 or 3 years, they immediately fell into some very, very severe losses. These losses were so great that General Motors and Chrysler went into bankruptcy. They had to be reorganized. The government came in and gave them loans. And what happened is the common shareholders of those companies ended up with nothing. If you owned a share of stock in General Motors or Chrysler in 2007 and 8, when they went into Chapter 11 receivership, you lost all of your investment. They reorganized, they shut down plants, they renegotiated their pension plans, they went and they cut these fixed costs. So as they emerged from bankruptcy, they were a leaner, meaner, smaller companies. And if you look at them today, they're very profitable. This will happen. In other words, they got into an unprofitable pocket in that economy of scale that I showed you earlier, and they could not get out of it without going into receivership. Let me ask you a question, interesting enough. Why didn't Ford Motor Company go in bankruptcy? Chrysler and GM did. Why didn't Ford? Ford didn't go into receivership. Well, there's a very good reason we talked about earlier in this class. 40% of the voting power is owned by the Ford Motor Company family, consisting of about 70 or 75 members. They got the management of Ford Motor together in one room, the family did, and said, "You're not going to put this company in bankruptcy because we're not going to lose our investment. We want our dividends." I mean, some of those people probably never worked a day in their life. They depended on their Ford Motor Company stock to provide them their income. So they said, "You can go out and borrow all the money you want, but don't put us in bankruptcy." So the management of Ford Motor Company went out and they mortgaged everything, including the famous F in the circle, and pulled out of it, and they're as profitable today as General Motors and Chrysler, who went through bankruptcy. Interesting story. Now, let me pose a question to you. Let's say you're starting a new business. Let's say this is you're just a little backhoe business. You're going to dig some basements and put in some sidewalks. So you'll need to have a little single axle dump truck and a little bobcat, probably a shovel or blade, and some items like that. Now, you have two ways that you can secure your dump truck and your bobcat. You can go out and buy it and go to the bank and finance it on a conditional sales contract. And you'll own that bobcat or dump truck. Or you can go out to the equipment house and you can lease it from them on maybe a monthly basis. Rent it. If you're a new company, which would you prefer to do? You probably should be leasing it or renting it. Now, the rental is going to be a variable cost, and the rental rate is going to be higher than the payment would be if you financed it through the bank. The reason for that is you're passing the risk of your possible failure back to the equipment company you're leasing it from. So if you go broke and you own the equipment and you're obligated to the bank to make payments, those payments are fixed costs. And the equipment is parked against the fence and you still have to make the payments. If you lease it, you can just take it back to the equipment leasing company and say, hey, great, sorry, my deal didn't work out, and here's your Bobcat and dump truck, nice knowing you. Now, as you get more secure and you grow, then you're going to want to take on that risk yourself because you want to lower your cost. So you will, in the long run, want to own the equipment and be making payments to the bank. And if you expand and grow, you'll be spreading those fixed costs over more units of work, and you'll be more profitable. And that's why we see as companies get older, they get a higher operating ratio because they have a lower percentage of variable cost to their total costs. But when they grow, they're more profitable. But if they don't grow, then they're going to fall into a loss much more rapidly. Very, very interesting scenario. We've had some very interesting things we talked about today. First, about break even. You have to break even to make a profit. And it's very difficult to reach that break even point. Last day of the month, maybe. And then once you get profitable into a break even position where you're making money, you have to be very careful that you don't get yourself in a situation where you go into a loss because you're adding fixed costs faster than you're generating revenues. And then once you get there, looking at your operating ratio, you want to make sure that you continue to keep your market share and your expansion, and you don't fall into a loss such as General Motors or Chrysler. So now you can relate this operating ratio back to the diseconomy of scale and back to the break-even point.